Thank you for joining us today. We really do appreciate it. We have several hundred of you registered, and we're excited for the support. I'm joined today by my partners and co-heads of Alternative Credit, Joel Holsinger and Kevin Alexander. For those of you who are joining us for the first time, and that's many of you, we hold these webinars twice per year. One of those tends to happen during our annual investor meeting, our AGM, which is really only open to current investors and prospective investors. And then the second one, which is this one, we open it up very, very broadly. So a number of you are new, and we appreciate you taking the time today. The agenda for these webinars is pretty straightforward. We want to share our views with you about things that we are finding interesting or developments in the alternative credit or asset-based credit markets. We tend to offer those views pretty unvarnished. And the webinars really are deeper insights or other conversations around our recent newsletters. And we're proud to say that our newsletters today are reaching over 10,000 readers, largely institutional investors, many of whom, however, are not as familiar with asset-based credit markets as we obviously are. And so it's a way of helping provide some insights into those markets.
10,000 that we know of.
That we know of, that's true. That's as many as we can measure. We got some really terrific feedback during our last webinar, which is going to change the format of how we're doing things today. We've, in the past, done slide-free webinars. We're not going to do that today. So we've got some additional data and some graphs and charts that we want to share with you, and we're going to discuss. These are things that we wanted to include in the newsletter, but for the fact that it would have made the newsletter even longer than it already is. They ended up on the cutting room floor, so to speak, which isn't to say that they're not interesting or irrelevant. They are, and that's partly what we want to share with you today. And then in light of today being the 1st of April, Kevin and Joel, I have a special surprise for you if there's time at the end. That this will not be, Joel's having flashbacks now to some other quizzes, if you will. So I'm going to ask you some questions at the end here, speed round style, and see if we can get your reactions to some of those things. But in the discussion today, and I'm going to share my screen again with everyone. I'll throw up some slides. We'll explain what you're looking at, and then we'll drop the slides and we'll discuss it. But in today's discussion, we're really going to talk about 4 big topics. These are very relevant to things that we talked about in the newsletter, but just additional insights. One of those related to the housing market. And while we'll focus on the housing market and residential mortgage market in the U.S., what we'll talk about really extends well beyond the U.S., and most developed economies are seeing the same trends. We're going to talk about the credit curves, flattening of credit curves that we're seeing in the market. We'll talk about what that means. And then we'll look at consumers. So we often talk about consumers in the newsletter, and consumer credit performance and spending and that sort of things. We're going to talk about some behaviors that we're seeing there. And then finally, solar. Solar's been in the news lately, and there's some lessons learned taken from some data that we're seeing in the solar markets. Well, those are the 4 big topics that we'll tackle today. So Joel and Kevin, you guys ready?
We're ready.
Ready.
All right.
We're not so sure on the last part, but
well,
what Keith
I'm
isn't
excited
saying
about
is
that.
normally at our LP annual general meetings, we've had something we basically call Embarrass Joel, where Keith pops a number on stage and I have to guess what that number is related to. Yeah. Totally blind, no idea. So hopefully your idea at the end is not necessarily quite that publicly embarrassing.
Yeah, hopefully. It won't be like that. I assure you, I won't be like that. Anyway, so let's talk about the housing market, mortgage market in the U.S. And I have 2 slides here, 2 graphs that describe some demographic shifts or trends. These are long-term shifts or trends, so it's not news. But I want to talk about the implications on the market, and then I have a 3rd slide that's going to take a slightly different spin on this as well. So this first slide here, pretty self-explanatory. This is a long-term study of what share of the mortgage market our home buyer market is represented by first-time buyers. And you can see the general trend, certainly over the last 10 years or so, has been downward, such that first-time home buyers now represent, only about a quarter of all homes being purchased these days, whereas it's been as high as 50%, 40s and 50% in the past. So that's one trend. And then a similar type of data, looking now at the median age of home buyers. Again, this is US data, but the same trend applies whether you're looking at Western Europe or Canada or Australia and New Zealand. We're seeing the same kinds of trends. Median age of buyers has only been going up, and particularly in the last few years, where we're seeing as first-time home buyers, the median age is almost 40 years of age, which is interesting. And the average or median age of all buyers or repeat buyers is, in the 50s and 60s. So that's a new trend. So the question I have for you guys, Joel and Kevin, is does this have any implications on how you would see risk or market opportunity, or how you compare historic performance in mortgages to today's performance, given the demographic shift that we're seeing in these charts? And I'll drop the screen.
Go ahead, Kevin.
Yeah, one little tidbit to add, and I was thinking about this a little bit, was I didn't appreciate that the median net worth for a homeowner is around $400,000. And the median net worth for a renter is around $10,000. So that means a homeowner is about, 10 times, about 40 times more worthy from a credit perspective. So it's harder to be younger. There's a lot more pressure with respect to student loans. There's a lot more pressure with respect to some of the debt. There's a lot more issues with respect to shortages of affordable housing. So while and I think I mentioned this one of the times we had talked on the last webinar, was it's great to be a consumer from a borrowing perspective, but it's getting tougher to be a consumer lender. And so I think what we're really seeing is as these home prices continue to appreciate and as rates have been rising, but maybe now stable, the access to put down that down payment, the ability to continue to perform, or, most people are considering working in a two-family household where everybody's working and so on and so forth. So careers are starting later, dual income. That's creating more pressure with respect to consumer performance.
Yeah, it's interesting. I had to Google this when you showed me this chart, Keith, which was what's the percentage of first-time home buyers, and it is around 32% last year. That number's moved around a lot, but there's really, I love it whenever we always talk to the team about perspective from the standpoint of you got to zoom out. I love that one zoomed out. I will say, the older I get, I've been doing this for 28 years now. The older I get,
pretty young.
I'm still pretty young. But the older I get, the more it gets a little depressing when you zoom out and you're all the way on the left. When my eyes migrate to when I graduated high school, and I was looking at that chart and I'm like, I'm almost off the page in 1993. That's kind of getting a little depressing, but it's interesting when you zoom out that far to see that trend line, to kind of see that come across. And obviously it's been this long-term trend line. I think the second chart, frankly, is way more interesting with regards to the median homeowner and other piece. I think there's a couple things to tackle there. One, Kevin talked about on how much harder it is with regards to first-time down payment. I think the other thing I remember is, and this is it's accelerated post-GFC, is there were a lot of very aggressive programs towards first-time home buyers, including subprime and other areas, where they might have had a $10,000 net worth, but they were buying a home. That obviously created the housing crisis and what we went through, or created the subprime.
They should never have been a homeowner, right? They should have always been a renter.
So some of that was, frankly, the trend was artificially still high. It should have actually come down more, but because of the aggressive programs that came out of the late 1990s, ironically by Dodd, who ended up, then shutting down some of that. If you look at some of the fair housing prices and other things they were trying to do with the FHA and Fannie and Freddie and the opening up, that really created the subprime crisis. So the reversal of that has accelerated effectively that decline in that piece. I think the second part, and we talk about this at times, but as both of you know, it's been my pet peeve for 15 years, but it's really starting to be in the broader headlines, which is demographics. If you think of the demographics there, it is really just the aging of America. We are below replacement rate at 1.6 versus the 2.1 of replacement rate. And honestly, we're in the lead because most of the world is shrinking faster than the US. With net migration, we're actually still growing barely from a US standpoint. But if you think of that from who can afford to do a new home, most of your migrants aren't those who are going to be your first time home buyers. It's harder for them. They're not necessarily even eligible for some of the programs until they get full citizenship and other programs. And unless they come in wealthy, effectively, they're not a home buyer. So that shrinking demographic is leading to it. And then obviously the delay of marriage, the delay of having kids. I think you and I, Keith, feel this with our own children. You continue to see this obviously throughout the entire team. We see this throughout all generations, which is, people are delaying when they get married. People are delaying when they have kids. The point that 38 is the age is kind of shocking, honestly, when you think of how far that is. Whereas I think I was 25 when I bought my first home, according to that. And so that trend is not changing. And I think it's one thing as an investor, which is we really do, need to be more aware of that because, there's a lot of talk now about 30 years of declining rates and how things are different now and how it offsets that. Well, the other thing that's different is 10,000 years of history of growing populations. And in many parts of the world now, we're going into shrinking populations. And Southern Europe and Eastern Europe and Japan and China and Russia have already gone past that apex. They're already declining in very significant ways. And a lot of other parts of the developed world are going to start to shrink. So we should expect that trend to kind of continue as you see that aging of the population and you see that delay of marriage and delay of birth.
Yep. You mentioned the GFC, and the next slide here I want to throw up here, I think has some implications from that. Let me show you this slide here. So let me explain what you're looking at here. Recently, very recently, the rating agencies have, and the S&P in particular, has published new criteria for the rating credit enhancement required and this is, I think, primarily non-QM residential mortgage-backed securities. And what you're looking here is a kind of a before and after picture of that change. And and I apologize for the labeling here. I just noticed this bottom tranche, if you will, represents the AAA. The next one, the next shade darker blue, is the AA, single A, triple B, double B, and then reset. That's how to read this chart in terms of just credit, just the layers of a mortgage-backed security. And what we're seeing is with the new criteria, there is less credit enhancement that's available to all of the debt tranches. And in the case of, and you can look at it proportionally, the IG tranches, typically beloved by insurance in particular, single A, triple B rated, now have a third less credit enhancement today, or would going forward, following this change in criteria. So more leverage. Now, that's what I'm saying. Maybe this is a little bit of a normalization of things since the GFC. I think there's implications for risk potentially, but as we talked about the demographic changes and the average age of a mortgage holder these days being higher than it was back then, maybe this is okay. I don't know, Kevin, what are your thoughts on this change? Is this just a sign of more leverage coming into the system and things getting riskier again, or is this okay?
I think what Joel touched on this a little bit, right? So there's a more pristine screening now to be a home buyer, right? So you don't have the artificial teaser rates. You don't have some of the excess ability to just get a mortgage when you should have been a renter. So if you're going to buy a home, you're now older, you're more responsible. You got to put 20% down. There's a reasonable amount of equity that is in a homeowner. And I think the rating agencies have been prudent with respect to historical performance and have seen there's been good performance with respect to preserving and protecting someone's home. So I think this is more of maybe we had some excess in the sense that we were really conservative on how we re-underwrote mortgages. I think when you said non-QM or non-qualified mortgages, if you said that 3 years ago, you meant subprime 2.0, and that was not correct, right? These are high FICO score borrowers that are probably own their own business, but at the end of the day, they are nothing to do with a subprime owner. They're still coming up with a 20% deposit. They still have a reasonable net worth. So I think the market needed some time to go through the adjustment of going from the excess of no money down, but you could buy a house and you'll default maybe in 9 months. But at the end of the day, here's the product and I'm willing to lend it to you. And I think we know that if consumers can borrow, they're incredibly intelligent and sophisticated. They will figure out a way to borrow, and then ultimately we'll see what happens. So now that it's been a more stringent underwriting process for both agency mortgages and non-agency mortgages, in particular non-QM, we've seen really good performance. Now, what I don't know will continue is this concept of the HPA or home price appreciation that has been going on with respect to the COVID years, right? So if you bought a blind man that bought a house in 2020, bought something that is up 50%. And so that's a pretty significant home price appreciation in the last 5 years. So maybe that's slows down or maybe declines slightly, or maybe we have some form of mean reversion, which will help bring us back to this equilibrium of affordable housing. But at the end of the day, this doesn't seem like excess leverage to me based on the screening that we have and the performance and what's going on in the mortgage market.
Do you think spreads are going to widen as a result of this by just having less credit enhancement? Or do you think the market is just saying, we agree with the rating agencies, there was too much credit enhancement, if you will, too much credit enhancement before based on loss expectations?
I think buyers today are really doing fundamental analysis. So they're looking through the underlying FICO scores. They're taking a look at certain geographies. You know, obviously California's had some concerns with respect to the wildfires. I think we're going to see some pressure in sort of the Virginia, DC area with some of the government layoffs and so on and so forth. I think credit spreads are probably going to be more correlated or impacted with respect to the macro environment than the sort of this micro change, because I think while the rating agencies are helpful for both capital charges and also implying what the losses are, I think fundamentally investors are doing their own analysis from a cumulative default scenario standpoint. So no, I don't think it will have an impact with respect to credit spreads just based on this change.
Okay.
I would say you could even make the other argument, which is, you know, we'll talk about it later, about supply demand. The supply just got smaller. So, you know, I would say you could argue that spreads will be flat or potentially tighten. Now, I think Kevin hit it on the nose. I'm normally the perma bearish one who would say that, you know, and that chart's meant to scare you, obviously, with regards to more aggressive standards. I think the thing that often gets missed when it talks about leverage, we got asked a question about high leverage, and the answer is, well, tell me what the asset is. You know, you really can't speak about leverage in a vacuum. You have to kind of all things in moderation. There's some assets that if you put $1 on leverage on them, I would say is just crazy and you should never be doing it. Bitcoin comes to mind, you know, other assets like that.
But that's not an asset, is it?
Well, that's not an asset. That's valid. There's other things that obviously are very, very good assets recoveries. Because I think the thing, maybe pull back up, Keith. I think the thing that probably is worth focusing on, Kevin mentioned it from a screening standpoint, which is, okay, so the AAA goes from 75 to 80% from an advance, if you think of the visual there effectively.
Yeah, that's right.
But the underlying loan on average is 70% or less loan to value. So 80% is still 56% to the underlying house. So when you think about it from that standpoint, that's actually not that aggressive if you think about where you are, and it is AAA type risk. And obviously, even if you go all the way up to 90% with regards to the underlying, you're still talking about 63% on the underlying leverage. And so that does come down to what Kevin mentioned, which is HPA, it's home prices risk. What we are seeing in the markets, and now I'll put my bearish hat back on, is what Kevin mentioned, which is we're seeing a very split HPA economy. You know, there are markets that are still growing and still doing very, very well, and HPA across the country is still up. Honestly, to our surprise, if you'd asked us a year and a half, 2 years ago, we actually thought we would see HPA declines because of the higher rates and the affordability that would come out of the higher rates that were going through it. What we've seen is, one, people have just kept their homes, and those who have 3% mortgages are just keeping them for longer. But two, the reason
they have to, right? Those are assets now, right? If you
those
have a
are
2.5%, 3% mortgage, like I don't know how you can
hang
move.
on to that as long
the
as
liability has become an asset for sure, as you like to say. And I think that when you think about that on a broad basis, I will say that like we expect some volatility, but in fairness, if you want to take a bullish towards housing, the housing shortage has only gotten worse because there's been a slowdown with regards to new permits and new construction. The housing shortage has only got worse because of the growth. We continue to actually grow as a country because of migration and other things. And I think the probability is rates will go down more than up from where we are right now, at least my personal opinion. And if rates do go down because of a slowing economy or a potential recession, that's actually very positive for housing. Now, in fairness, don't be surprised if rates go down and and we see more activity on housing sales and actually HPA is flat to down slightly, because you're going to have a lot of things that come to market all of a sudden for people that were pent up sellers, where it actually does mess up the supply demand, and you actually don't see what we've seen historically, which is rates down is the most bullish sign in the world for housing.
Yeah, agree. Okay, let's move on to the next topic, which is this concept of credit curves. And what we mean by that, for those who may not traffic in credit curves every day, it's rational, it's normal that as one takes more risk, one or enjoys more or less credit enhancement, you're commensurately compensated for that. But that incremental return of taking more risk is not a static thing. That is constantly in flux. So what I have here is a slide. We're going to start with subprime auto for a couple of reasons. One, subprime auto has been in the press for the last year or so. We've been talking about it for longer than that in terms of just fundamental credit performance deterioration, seeing increasing delinquencies, increasing defaults, with the post-COVID drop in used car values. We're starting to see lower recoveries on all that. So there's a lot going on in subprime. We talked about this in the last newsletter and others. In the wake of that, what we've seen is not only is the absolute level of return decreasing on subprime securitizations, auto securitizations, but the credit curve is flattening. Let me explain what you're looking at here. Let's go back to February 2023, so 2 years ago or change. And if you were to buy a subprime AAA bond, you're going to get paid something almost 100 basis points, call it 90 basis points spread. And then you got paid, a little over 100 basis points to buy the AA, maybe 150 to buy the single A, and then you would get paid an almost 250, another extra 100 basis points to buy the triple B. And if you stepped into the double B, you would be making almost 600 basis points spread on that bond. And then fast forward to more recent markets, and the more recent tight was just about a month ago, where we saw that credit curve is flattened, so that incremental spread that you're earning, moving from AAA to AA to single A, triple B, double B, the incremental spread you're getting is less, and the absolute level of spread you're getting is also decreased. So that's how to read the chart. So let's just maybe talk about why this would happen. This is a little counterintuitive given the fundamental backdrop, particularly of subprime auto, but we're seeing this everywhere, by the way. If I showed you CMBS, we'll talk about that, RMBS, and CLOs, we're seeing the same credit curve flattening. So Joel, Kevin, what's going on here? Why is this happening? Does this make sense?
Yeah, look, we've seen this tightening, and obviously, if you look at the last two versions of the newsletter, we talked about this with regards to getting ziggy with it. And if you haven't read, it's a good read. Or if you go back to the market screams like a pig. Both of those talk about the supply demand imbalance going on, especially as it relates to the rated market and the IG market and the insurance market, where there's been a lot of inflows that have pressed that. So, one of our rules is watch the flows, and you've definitely seen those come in. And I'd also say it also speaks to the volatility we've had in the last 30 days, 45 days. If you think of all of the volatility of the equity markets, now look at this page and realize that, yes, things have widened.
But
barely.
not a lot.
Kinda.
Not a lot.
Kinda.
Kinda. You got to squint.
You have your glasses on so you can see it, but most people would say it's kind of the same.
But it does, and that's kind of true across the credit markets right now. We've seen little tiny price movements, but in fairness, we're not even back to January, with regards to the tightening we're seeing. So it is a flows. And if you look at it, maybe flip to the next page, Keith, because I think it's actually more interesting when you go to things like CMBS and CLOs, where it was even more stark with regards to parts of the cap stack. Yeah. This pushes people out the risk curve, because as much as you would logically, if you looked at this, you would say, why would I own the AA or the single A? Why wouldn't I own the AAA as tight as it is? The reality of the matter is that there's certain fundamental floor levels where things stop working. Where in my model, if I'm insurance with the leverage I have, says, you know what, that AAA doesn't work. I'm just not making enough spread, because everything still in this world comes down to asset arb. It is asset liability arbitrage. And if your liability is more expensive than your assets, clearly you're not going to do that. Well, what happens is we're getting to this point, and I'd say we actually went past it in the fourth quarter, in my opinion, where I've been calling it $20 oil. And what I mean by $20 oil is we've gotten to the point, as much as we spoke about in the newsletters, where it frankly is hurting a lot of the issuers, or a lot of the buyers in this market, not the issuers. The issuers love it. It's hurting them to the point where the model doesn't really work. And the reason I use $20 oil is just because you can't make money drilling something at $20 oil doesn't mean you can't go to $20, but you can't stay there for that long, because eventually nobody drills.
Probably longer than you'd like.
Longer than you'd like, but eventually everybody stops drilling and the supply demand fixes itself and you go to the other side. And I think what we're seeing is the broader markets have kind of seen that. I think public equities, if you really look at the run up in the last 2 years, all we've done with a 10% correction across most of the markets is go to some of the second highest valuations on a multiple basis we've had basically in the last 10 years or so, because most of the increase was not earnings in the last 2 years. Most of the increase was valuation multiple expansion, and we still haven't really given up a lot of it. We've just given up a tiny bit of it. And so I think that's what I mean from that standpoint, is it does a sign of we're closer to end of a cycle than the beginning of a cycle. I think that all of us, and we'll talk about this later, I'm sure, we're probably relatively positive, if you go back 6 months or a year ago, of a slowing economy, which we continue to see, but not necessarily a recessionary economy. The point that we're now talking of the risk of a recession shows how quickly we've slowed since then, with regards to the uncertainty on the future and with regards to some of the volatility in those markets. So I think that we're probably seeing the tights, frankly, and I do think we'll snap back up, but I think that's all driven by the flows, as we talked about in the newsletter.
Well, I want to maybe, Kevin, I know you're going to weigh in here, but I wanted to just point something out here, and it's not terribly obvious when you talk about subprime auto, because supply in that market is still not crazy, right? But we did see significant supply, new issuance in CMBS, CLOs last year, like significant. And despite all that supply, we still saw that credit spread tightening. So we talked about this, I guess, in the last 2 newsletters, talking about that insurance bid. And CMBS is a good example of this, where it's not only attractive, from a capital perspective, spread pickup over corporates, but it's also one of the few sectors in our world that's fixed rate, that has some duration to it. And almost anything that had duration and fixed to it that worked economically for insurance liabilities was in high demand, and I think that explains part of that.
And it's not even just insurance; it's pension funds. It's not just annuities. It's life and mortality. everybody's grabbing yield because they do believe rates are going down.
But that
and
insurance concept, which is 100% factual, really justifies the flattening of the investment grade curve, right? I think, Joel, you basically said, what's the difference really between a AAA, AA, and single A? Let's ignore triple B for a second. So that makes sense to me that, if you watch the flows, there's a pretty significant desire to be more in a yieldier single A or AA than a AAA, and you can justify some flattening there. And you can make an argument that's the real investment grade part of the curve. But the credit curve, when you think triple B, double B, when that has been tightening, and I think we only glanced over this, you have some stock market volatility, you have a lot of trade stuff going on, and I guess spreads are kind of out like a touch, but not really. So there's a big disconnect right now between the credit markets and the equity markets. And the first chart that Keith showed, that subprime auto, that's your renter. That's not most likely a homeowner. So he's a renter. He's really exposed to inflation. He has a lot of, consumer performance criteria that have to be evaluated and so on and so forth. And it's been great to be a consumer. They have a lot of access to cash. They've been able to consistently pay, maybe a sloppy pay, but they've been able to consistently pay because we have jobs. So I think the real question is going to be not necessarily the full credit curve, but maybe the non-investment grade credit curve going forward. What is the slope of the curve from triple B to double B? That's where you've had some extreme changes. So your chart in 2023 to 2025 looks pretty different. But like it's kind of inching a little bit. I can't like bring my angles out enough to say that if we're starting to increase that curve in the last couple months or so, but I think it's only logical that that's probably the most exposed part of the market. So there's more downside risk there than upside return if we do think we're nearer credit spread heights of all time.
And I'll just close with this, which is the cycle. The cycle creates itself. There's a snowball effect. There's a reason cycles happen, and it's human nature, but it's also what happens. And you mentioned it, Keith, with regards to CMBS issuance and CLO issuance in 24. I think the thing that's often missed is that snowball effect, which is a lot of the activity, especially in CLOs in 2024. There was a ton of resets. So effectively, when the market gets really tight, everybody goes and refinances their old liabilities, which then only gives them cheaper cost of capital, which makes them more of an aggressive buyer in regards to the assets. Or in the subprime or others, the cheaper capital I get, the tight, sometimes the credit box widens because now I'm actually have a cheaper liability, which allows me to get a little more aggressive. And all of a sudden the music stops. It's that whole music, money makes the world go round, credit makes money go round. That portion of it always is true because you go through that snowball effect that comes out of the second and third derivatives of some of what we're seeing on those pages.
Yeah, the other thing that's sort of baffling is, credit curves are not necessarily theoretical and practical. What I mean by that is credit curves are just an observation of the market, but they're not exactly linear. So when you add into the fact that 2 years ago we had much lower rates, now we have higher rates, people look at absolute yield, did that have some spread compression with respect to the flattening of the curve? And then Joel, if you're right, and we do have some lower rates at some point, does that actually, bring the curve back and create some steepness and so on and so forth? So it should. I mean, it feels like that's
logical. I agree
logic.
with you, but for the fact that the term structure of interest rates has been pretty flat. If you had an upward sloping yield curve and you had that would be more intuitive. If rates come down, then you're adding more spread to make up the difference. But you've had a pretty flat term structure, which suggests this spread curve is just loss yield to double B investors, for example.
Well, that's the structure, though. It goes to why we call our newsletter In the Gaps. Everybody has a box they buy to. Like risk is elliptical, but nobody prices it elliptical. And the reason it looks linear is because effectively there's buyers of each one of those boxes that kind of keep it within a certain framework, which is why you have to sometimes. Correct.
All right, well, let's switch gears a little bit. Let's talk about the consumer. It's come up a couple of times already. It's something we talk about a lot in the newsletter. And when we talk about it, we've been pretty clear that we're focused on consumer credit performance as the harbinger of things to come, as opposed to consumer spending. But it's not that we ignore spending. In fact, I want to show a slide here that talks about spending, consumer spending, changes in spending behavior. Not that we think is the indicator of credit performance, but is, I think, an indicator of economic wherewithal on consumers and some of the pressures they're facing. We're going to look at this through the lens of restaurant, going out to eat, basically. So let me share.
Joel's favorite hobby.
That is actually a fact.
It is actually true. Does it count as a food analogy if you actually bring it up as a slide?
We should though. So I have two slides. They're related. It's related data. This first slide, this first graph is a survey of all kinds of restaurants throughout again, this is US, but this, again, phenomenon extends well beyond the US borders. A survey of all restaurants. They asked a simple question. Are you seeing more folks coming into your restaurant or fewer folks coming into your restaurant? And the answer for the last 12 months anyway is folks looked at how restaurant owners looked at how much foot traffic they had, is that more than half of the restaurants saw less foot traffic last year over the last 12 months, and only a quarter were seeing higher foot traffic. So that's interesting. And then the next chart kind of peels the onion back a little bit. On the left side here, this is that same kind of data, but now broken down by restaurant type. And for those who are unacquainted, QSR stands for quick service restaurant, and think of that as fast food. And then you have fast casual, which is not quite as fast, and casual dining, which is slower still, and then fine dining, which is where Joel likes to spend most of his time in the evenings.
No, I like
that's not always true. He likes a good ramen noodle soup.
I just like good food.
Takeout. He's a good takeout guy. That's true.
Yes.
That's valid. But you can see some of the shifts that have happened, and it's affected all types of restaurants. I think that's the first takeaway. There's been more volatility in fine dining, which is a higher beta product, perhaps, or it just shows consumer, pent up demand, perhaps, versus more of a normalization. I know how you ever want to interpret that. On the right-hand side, same kind of data, but now not looking at traffic, looking at pricing, the cost of things on the menu of the restaurants. And restaurants have been getting hit with themselves with inflation in two ways. Wage and labor costs have gone up a lot for them, as well as just the cost of their ingredients has been affected a lot by inflation. And they try to pass at least some of that inflation on through higher menu item costs, which is what's reflected here. And what we're seeing here is another trend toward some sort of more limited ability to pass those costs on, and overall inflation, menu inflation, kind of hovering in that 2 to 4% range, which is consistent. So anyway, that's the data. I just wanted to get your thoughts and implications. Does this mean anything as we look at this consumer behavior and restaurant performance? Does this have implications in your mind on what's going on with consumers or households?
I think one of the things, though, that you mentioned there is it's getting really hard for restaurants to pass on the cost to the consumer, right? I mean, Joel will debate whether or not economics actually has a supply and demand and so on and so forth. But
supply and demand works. It's everything else that's kind of more theory.
But I think that means that there's pressure from an earnings perspective, right? So clearly you had that fine dining chart when they tried to pass on some of the cost to the consumer, that really dropped some of the traffic. So there's a correlation there on what they can pass on, which is a little scary, right?
You think that fine diner is probably, they're maybe a little bit, they're spending bigger dollars. They probably have more wherewithal. They might be more inelastic.
You would think that, or that would be more intuitive to me, but I don't think your chart shows that, right? I think your chart is basically saying cost of eggs went up, this went up, your soup's more expensive. Yeah, I don't know, it's too expensive to go out there to dinner. Let's not go there tonight. So there seems like it's less inelastic than we would have expected.
Well, I would say it's what we talked about earlier on perspective. If you zoom that chart out, because I've done a lot across franchisors and other things in the past, what you would see is that all we're really doing is return to normal. If you really look at it, since 1990, effectively restaurants have had generally more traffic decline than traffic growth. Only certain ones have offset that. And all of the same store sales gains have really come from check. They've come from average check more than they have from traffic. So really the prior 2 years and what happened was a post-COVID effect, and we're really reliving this. But you've seen this across asset classes. You saw this huge increase in valuations across real estate, and then a correction. You saw venture capital obviously go to crazy levels and then starting to go through its periods of correction. This is the return to trend line in many ways, which is that portion. To the fine dining, expect volatility because it's also normally one of your best indicators. The two best indicators with regards to recessionary when it comes to restaurants and consumer are: one, do you start to see a trade down? Do you start to see people go from casual to QSR and fast food or fast casual with regards to just sensitivity on price? And if you look at the headlines, there's a lot of volatility going on in restaurants because it's really hard to make money right now because of all the inflationary pieces you talked about on the expense side, as well as what we're now seeing. And they've been living off these big price increases while getting traffic. And the other one is fine dining, because what happens is it goes fine, the consumer's fine, there's no issues, the consumer's spending, and boom, because a lot of it's expense budgets. And the second that the T&E
that's a good point. Business lunches,
it is. It's business lunches, it's business dinners, it's travel and other things that, especially when you think about fine dining, it's recorded there because they get more the chains than they do the actual individuals. So you're getting your Mortons and you're getting your Ruth Chris and you're getting your higher ends. And so like it's a really good leading indicator coming in. And when it falls, it absolutely collapses. If you did that on a 25-year chart, it would basically be right around the time of recessions, normally on a normally leading.
Yeah, it's one of the reasons we like to look at restaurant data in particular is that it can be a really interesting leading indicator, same as other kinds of non discretionary spending can be.
The thing that's confusing to me for restaurants too is we're still going through this pattern change from COVID, right? So COVID is only 5 years ago. Obviously, there was a giant work from home craze. For the most part, it feels like people are encouraged to go back into the office. But, even that changed to the extent of a firm going from a 3-day to a 4-day or a 5-day work week. That will change some of the traffic with respect to the restaurant. So there's a little bit of mean reversion. So I don't disagree with that at all. We're just going back. But I think there's a little bit of confusion on what are the permanent pattern changes that we're going through from a COVID perspective.
There was a question.
We're going to run
just one thing real quick, Keith. Somebody asked a question, does it include Uber and delivery? Normally it does, on average check in regards to traffic. It's normally in their data. Having said that, if you peel back the onion, there's actually been a massive decline on the delivery and the takeout and the Uber because basically people got tired of it and it was a post work from home and other things.
Unless you're my kids.
That revenue is not great revenue because the skim that's getting taken by the delivery organizations don't make as much as you would think on a lot of that. It's better revenue for your higher end because a lot of their cost is actually in the kitchen versus others, but it's not been working as well as people had. And you actually are seeing restaurants not love their delivery as much as they used to.
Yeah, that's true. I think I heard something like they take about a third of the.
The bigger guys get better deals than that, but it can be as much as a third.
Yeah. All right. Switching gears so we don't run out of time. And this is,
sure.
I wanted to make sure we got to this because it's a really interesting case study and some lessons learned here. I want to start with some economic fundamentals and one of Joel's famous, what you love to say, and you said it a second ago, is the only rule or law that in economics it actually works is the law of supply and demand, which is to say you create more of something, you would expect the price to drop. And if the price drops, you'd expect more demand. And that's the simple rule. Kevin, you're the economist in the room, so you can testify that this is true.
The rest is weather forecasting.
So let's talk about the story of solar energy. It's been in the news. Solar companies, and particularly those that build and install solar panels on homes, so residential solar, has been in the news lately. A lot of those companies have been under significant pressure, and some have failed. And so the economics of that businesses have changed quite a bit. And I want to talk about that. But let's start here. And this is looking at the supply. So we're thinking about this law of supply and demand. The supply of energy coming from solar. This is data that is US data, but it has a high skew toward California because that's where a lot of that development has happened. And it just shows kind of a long-term overall trend or growth in the supply of solar energy. And you can see that's been pretty steady. Now, the pitch to a resident for solar is put solar panels on your roof. You're going to pay for those, but the savings that you'll undertake by not having to pay an electric bill will more than be compensated by the energy you're getting from the solar. And as a bonus, if you have excess energy, you can sell that back to the grid. And oh, by the way, we're going to throw in some tax incentives for you to make that initial capital expenditure. And then, in the, prior to recent history, you could finance that pretty cheaply if you wanted to finance the installation of those panels. So that's the reason why we've seen such growth in the supply of energy coming from solar, particularly in California. So here's where we're breaking the law of supply and demand. Here's energy prices overlaid on that graph relative to that supply. So for the first several years, the best you could say is that energy prices stayed fairly stable at around 13-ish kilowatts per hour, cents per hour. But as supply really ramped up, more supply, the costs also ramped up almost to a similar magnitude or increase. So what's going on here? Why is this happening? And why is this in a way been part of the story of here, why solar businesses have been struggling in recent years despite the growth, if you think of the demographic growth of the industry?
This is really where incentives muck up some supply and demand. So this is not an inelastic curve like a Chanel handbag that, when the price goes up, there's even more demand. I think when you end up with the incentive and the desire to create additional capacity, or as you said, more solar panels on the house and so on and so forth, people do unnatural things, and that creates a reasonable amount of excess supply. And so that really gets disturbing with respect to the law of supply and demand and economics. And
Well,
so
that should have been even more a case for why energy prices should have fallen more, because you had excess supply.
Can you use it, right? Can you actually use the supply? Can you sell it back into the grid? If you look at some of the company performance right now, again, public information, but like I think you're referring to Sonova going through a reasonable amount of agita or anxiety around that. But, were they creating a sustainable product that could actually be used? We'll see. The world has to play out there. But any sort of intervention is creating, I think, some concern with respect to what's the long-standing sustainability of a product, right? Do these solar panels work properly with respect to the harnessing of energy and then selling it back to the grid, or is that creating some form of excess capacity that's distorting some of the numbers in tandem with how energy prices are trading? So I think there's a lot to unpack there.
Yeah, there is. There's a lot going on. Joel, what are your takeaways and lessons?
Two quick things. One, there's a variable we did put on there where supply demand actually worked, which is the price of the actual panels went dramatically down over that same time period. So that part of the supply demand did happen. You did have the cost of installation decline a lot. So it made it more affordable and more distributed. The other is we didn't talk about California, which is, basically California represents less than 12% of the population and almost a third of the solar panels. There was, to use what you guys are both talking about, the thumb got on the scale too heavy. Supply and demand works until somebody puts their thumb on the scale. And the thumb on the scale there was definitely incentives. And it was both state as well as federal. And
that's cheating or unnatural, but yes.
It is. But that happened in a big way in California. And ironically, they put their thumb on the scale and basically made all kinds of incentives that made it very attractive to where 30% of the adoption in California, people with solar panels. So it worked. They got their solar panels, so much so that instead of being able to sell back to the grid, they turned it off. They basically said, oh, wait, nope, sorry. We're going to reverse some of those incentives. And that's why all of a sudden they took their thumb off the supply demand, and it kind of created this volatility that we're ended up seeing. So, that's the thing you run into sometimes with unnatural players.
Yeah. I think it's something that you think about a lot as an investor. If you're investing in an industry that is highly regulated, which means that there's some maybe not market conventions happening in that industry, or there's subsidies, government subsidies, where with the stroke of a pen, that can change the economics of that industry or the players, the impact on the players. Those are sectors you have to go in and knowing that if those things change, you have to have a good answer for what happens and what happens to your economic model, because that's what's, I think, part of the story here. So any industry has those where you're reliant on a government or policy that can, that's event risk type risk, it's very, very difficult to price.
Yeah, and we didn't zoom out. If you zoomed out, there's other things on the energy price side also with regards to basically shutting down coal plants at the same time nuclear was going offline at the same time. So you had other things that were affecting energy prices, and now you have the growth of data centers we talked about, and then the gaps. It's a big user supply. So there's other variables that were kind of playing into those things, but solar is definitely an example of things that kind of went a little wonky.
Yeah, this is a topic we may revisit again in a future newsletter, just because I think there's a lot of lessons learned.
You're just waiting for a bankruptcy or something before you can talk about it.
Well, honestly, it's a lot of thinking about how it's tied to residential housing in California as well, and the assumption, and I think it's still a safe one, is that because you're priming the mortgage with these financings, that you're safe. So you shouldn't see losses on residential solar loans. So we'll just see if all of that still holds true. If the goalposts are changed from policy or legislative action, and if that changes the risk there, it shouldn't, but that's something to think about. All right, let's go to the
surprise.
The surprise. So what I've done is I've come up with a few questions. Now, some of these questions are questions that were submitted by folks that have joined us. They submitted them early, so I've taken some questions there, and then I've adapted some others. So, but I've got a handful of questions. I've got a timer. I've got a timer on my phone, and I'm going to ask a question. You have just so many. I'll tell you how many seconds you.
It might be the hardest part for Kevin and myself.
That's why I'm doing it.
What is our timer? How many seconds do we have?
It varies by question. Some questions I acknowledge.
Well, that's not fair. We don't even know what we're answering to.
I will tell you. All
right.
It's not gonna be easy.
Let's do this.
You'll understand. So
I think Kevin should go first.
Kevin's going first.
Always the better looking person first. Yes.
Let me set up the question, then I'll tell you how many seconds, and then I'll tell you the question.
Okay, I'm ready.
That's how it works. Okay, so this week or whatever, late last week, Goldman came out and said there is a probability of 35% that the U.S. economy is going to go into a recession in the next 12 months. That's up from 20%. Not that.
I even read the article. Yeah, keep going.
Yeah. So that's the context.
Okay.
So you have 15. Let me get my timer here. You have 15 seconds to answer this question. Do you agree with 35%? And if not, what is your number?
My number is 55%. So I'm higher. 55. Just based on the trend line of unemployment going up. You're the 100th person to ask me that question in the last 2 weeks.
Oh, geez.
But I do think employment is under pressure. You've got a lot of the government layoffs. 55.
55. Okay. I have a duck. That's gonna count.
Am I answering, or do I get a different question?
You can answer. Sure, go ahead.
I'll go 45 because we're playing weather forecaster, so why not?
So you're just in between.
But I think it also goes to, if you went back to those same numbers, they were like 5 or 10% 6 months ago. So it shows how much it is weather forecast. Look, I think the only reason that I think it's also that high is we're going to hit a negative GDP.
We are going to have a negative quarter. Yeah. So I'm 50% there.
Jobs are going weak, and all we need is one quarter, and you're basically there. And weak jobs numbers, and you'd be there.
Okay.
Maybe I should go higher. Actually, now, you know what? I'm going to go 56%.
56.
I'm going to go Price is Right.
The Price is Right.
Okay. All right. Second question. Joel. This is for you, at least initially. You will have 10 seconds. Oh, so a little less time. You get my timer ready. Joel, you were very fond of saying, ignore the headlines, generally. Don't focus on the wave, this ocean analogy. Don't focus on the wave coming at you. Focus on the horizon. But we have lots and lots of uncertainty, particularly with consumers. We've talked about consumer credit deterioration, perhaps ad nauseum in a newsletter. spending behavior changes, which we're also seeing. There's inflation, which I know supposed to be going down, but now with tariffs, maybe not. So maybe inflation is still a thing. So 10 seconds. Do you agree with the concern around the consumer, or do you think it's overblown?
Yes on subprime, near prime, no on prime. I think prime's still healthy with housing and net worth, even though they're going to feel a lot poorer. So we could see weakening in the economy, which could lead to us seeing that decline, a weak recession.
Okay.
I talk fast. I get the
You
advantage.
did. You got it. That's all he does is he goes on faster speed. Do you have a different view, Kevin?
No, I agree with all of that. I think all of it does is it creates a repricing.
Okay. So related question. I know these are similar questions, but this is what the folks that submitted questions have. This is on their mind. I think it's on our minds as well. So third question, the context is all the market volatility that we've seen, particularly equity markets, but generally speaking, volatility. We've seen some weakening in credit spreads in the last couple of weeks starting to show up. You have 5 seconds, so this is a quick answer. Is this volatility a harbinger of bad things to come, or do you think this is just a phase and just a bunch of noise?
Who goes first?
That was
You can.
That's for
that was for definitely Kevin. Yes for equity, kind of for credit, but definitely yes for equities.
Okay, so you're a correction guy on the equities and weakening it, but not disaster.
Long overdue. Long overdue in equities.
I think it's a natural mean reversion, so I fully agree with harbinger of bad things to come. I don't know if that's too ominous, but I do believe that, you know, a mild correction, 15% from here is, you know, long overdue, just expected, normal course of business.
Like 30 seconds to answer his question. I don't know. Yeah.
Well, I'm favored.
I've given up on the timer, honestly. It was just annoying. All right, last question. We only have a couple minutes left, so by definition, we're going to be quick. But this is a harder one. So I want you to think about this. It's a tougher question, so you have more time. But I'll start with Joel, because I think Joel's going to have a good view on this. But Joel, you're not ready for this question, I don't think. I don't think this has come up before. Think about trade wars. And some policy-induced inflation or capital flows or market dislocations that may be coming or are here. Think about all of the sectors in our markets, asset-based credit markets. So think that's the context and think of our sectors. Name a winner and a loser, likely winner, likely loser from a sector basis coming out of all of this stuff that's coming, trade wars and capital changes or dislocations.
I'll go loser is easy. It's one of our nevers on shipping, because whenever you see trade wars and others, we're already starting to see it. I don't think people realize how much it's impacting. So I think that's an easy loser. I'll go winner. I'm actually going to go back to housing. I mean, if we have lower rates, it's only positive for housing. Obviously, that's all offset by how bad do jobs get. But if it is a mild recession where jobs are weak but not horrible, then that's actually neutral to positive for housing at a time where everything else might be slightly negative if you really go into the negative view.
That's great. I thought it was gonna be harder for you than that, but I underestimated you yet again. Kevin?
I would say the loser clearly is shipping, because when you're putting your
you have to name a new one by your own, Kevin. I already took
a new one. I would agree. Well, you kind of took that from me. The new one on the asset side, I would think private equity can win with respect to rates going down and with respect to the repricing and at some point M&A should pick up. So I do think that there's
cost of financing
hope there and so on and so forth.
There's rates lower. Yeah, I agree.
Yeah. So.
All right. We are out of time. I hope this new format was well received by everyone. If you have any feedback or questions that we didn't get to, we'll get back to you if we can. And otherwise, continue to submit those to our amazing IR team. Thank you again for your time and your attention. We appreciate it very much, and hope you have a wonderful rest of your day.